Happy Satoshi Sunday, everyone. This is segment number 7, I think. Today we are touching all things BTC TCs. That's Bitcoin Treasury companies. I'm not going to give too long of an intro for this because I think my dad is 100% a better explainer. So let's get right into it. Dad, how are you feeling today?
I'm doing fantastic. How are you, Gita?
I'm doing good. I'm excited to learn. This is one area of Bitcoin that I think doesn't really make sense to me. Because it's not an easy thing to study if you're not familiar with, businesses and how markets operate. So let's start from ground zero then. What exactly is a Bitcoin treasury company?
Interesting question, especially in this time when majority of the hype around Bitcoin treasury companies or digital asset treasury companies, DATs, and a bunch of other digital asset treasury companies like Bitmine that does Ethereum, and there are a couple of others in Ethereum, and there are a few Solana and whatnot. But since our channel is Bitcoin, not crypto, and I don't know a lot about other digital assets, so let's focus just on Bitcoin treasury companies. The idea was pioneered by Michael Saylor from MicroStrategy back in 2020. And whatever I'm saying, I'm kind of paraphrasing what he has shared in the various interviews that I've watched. So what I've learned is in 2020, during the pandemic, when the government started printing money, he started realizing that his cash is being debased by the government, earning 0% interest because the Fed basically cut interest rates back to zero in that era. So the treasuries are paying 0%. And the inflation was rising. And he was like, I'm getting debased. I cannot compete with Microsoft using my software business. Where do I go? Right? That's when he encountered Bitcoin and started studying. And then the light bulb went for him and he realized, I don't have to hold treasuries on my balance sheet. Right? I can hold other assets.
Mm-hmm.
Right? Now, why does it matter? Historically, when we value a company, companies are usually valued at the future value, present value of their future cash flows. Right? So this company is going to make $1 million every year for 20 years or 30 years. So all in all, it's going to make $30 million over 30 years using the cost of capital, let's say 15%, the rate at which S&P yields, give or take. And you will basically discount all those cash flows, and that's what the value of the company today is. Right? So majority of investors of the Wall Street does not give any value to your treasury. Treasury essentially means balance sheet. Right? Even if before we go too far into treasury companies, even when you are applying for mortgage or car loan, for an example, it doesn't matter how much assets you have. What banks look for is how much income you have. Can you service this debt with the income? Which is like mind blowing. Let's say if you are sitting on $1 million asset, you have $1 million worth of assets, and you are looking for a $50,000 loan to buy a car. You could sell your asset and buy it outright cheap, in cash today if you want to.
Mm-hmm.
But if you go for a loan, majority of the banks will say, nope, we need to see the income. Right? I have seen this firsthand multiple times in my career. Right? Whenever I was looking for a mortgage, they would always look for our incomes versus what assets do we have. and very little weightage will go to the assets. A lot of weightage will go towards the income. If our income is low, they'll say you can't qualify, even though your asset portfolio might be bigger than the loan amount you're looking for, right?
Mm-hmm.
And so that same logic applies to the business, is valuing a business. So now coming back to Michael Saylor's story, when he realized that he's constantly getting debased, his money is losing value faster than he can use that money, and he cannot invest that money into the business because he can't compete with Microsoft anymore.
Mm-hmm.
So for him, it was like, I'm in a lose-lose situation. And that's when he realized, what is the others, like what is a better store of value than treasury bills? And that's when he learned about Bitcoin, and he basically bent overnight and said, all right, we're going to take all our cash sitting on our balance sheet and convert it to Bitcoin. So good
Okay.
thing he did at that time was he did not do it behind the scenes. He basically came out publicly and said to the shareholders, this is what we're going to do, right? If you don't want us to be done, we'll buy back the shares,
Mm-hmm.
right? So if you don't believe in this, you don't have to hold the share. You can sell the share to us, give it back to us. We'll pay you cash. And then they'll use the rest of the money and went and invested
Mm-hmm.
in Bitcoin. And then Bitcoin started running, right? So now your assets started growing. So the value of the company starts growing. Now, trying it to draw a parallel with the individual, your net worth is not your salary or your business income. Your net worth is assets minus liabilities.
Mm-hmm.
Assets is your balance sheet, right?
Right.
On the credit side, and liabilities on the debit side, the net of that is what your net worth is.
Yeah.
Doesn't matter, you make $1 a year, you make $1 million a year. It doesn't really matter. Your net worth is not defined by your salary,
Mm-hmm.
right? So that started happening. Then they basically said, okay, you know what? How do we grow our Bitcoin stack, right? Then, he went on this journey of figuring out, because nobody had ever done it, so there was no playbook to copy. So then he started, going down this rabbit hole on this journey of trying and learning. So he did all kind of things. He borrowed against the Bitcoin. He borrowed convertible debt. And then eventually he landed onto all these preferred equities. He has 5 of them now, like Strike, Strife, Stride, Stretch, and Stream,
Yeah.
right? And we can talk about these if you're interested in these, but that's essentially the idea behind. So in simplest word, if I were to define what is a Bitcoin treasury company, a Bitcoin treasury company is the one which is converting its balance sheet into Bitcoin and has an operating business that kind of feeds getting more Bitcoin,
Okay.
right? The subtle difference in my mind here is, and my thinking has evolved from last time when we spoke about this a few months ago.
Mm-hmm.
I think all the Bitcoin treasury companies, they are not holding anything else on their balance sheet,
Okay.
right? They're basically saying all the free cash flow I have, or all the income I have, all the cash that I have, I'm going to use it. They might, like a human, like an individual, they will hold some amount of cash for their emergency fund. In strategy case, I think they have about $2.5 billion in cash right now on their balance sheet, which is to make sure that if Bitcoin was to crash, let's say right now, whatever is like 67, 68,000, whatever that number is, if it
Mm-hmm.
was to get down to 30,000, 10,000, they still have a duty or obligation to pay the dividends for all these preferred equities,
Right.
right? And they may not be able to generate cash using their equity or whatnot. And we can talk
Mm-hmm.
about that in a minute as well, right? So in a simplest form, a Bitcoin treasury company primary asset on the balance sheet is Bitcoin, have an operating business that generates cash to buy more Bitcoin,
Okay.
right?
Yeah.
Now, in this, there is this is again segregation of how these companies generate. So there is on one side, there are these miners, right? Primary asset is Bitcoin. They run their mining operations and they accumulate Bitcoin through that,
Mm-hmm.
right? And or they're selling the mining services to other people who are other investors or whatnot, and generate income through that and use that to buy Bitcoin and whatnot. On the other hand, there are companies like Strategy, Strive, Metaplanet, right? They're operating, even though they have operating business, their operating business is digital credit, right?
Okay.
And let's delve into that. What does digital credit means? How do banks make money for a minute, right? Banks take money from you, deposits,
Mm-hmm.
lend that out,
Yeah.
take interest from the person who borrowed money from the bank, keep most of it, give a tiny fraction to the depositor,
Mm-hmm.
right? And that's how they make money. None of them is their capital. It's your capital. Somebody else borrowed it. They are just building the bridge, right? That's all
Mm-hmm.
their business is. They are in the business of giving out loans, credit. Our entire economy, our entire monetary system is standing on credit
Yeah.
or debt.
Yeah.
So what Michael Saylor is pioneering right now is he's basically saying, in the digital age that we are moving towards with AI,
Mm-hmm.
the capital is becoming digital. So you don't want treasuries anymore. You don't want gold anymore. You want Bitcoin as your capital on your balance sheet. Now, if you want to hold some sort of credit, like why would you want to hold some sort of credit? As a young person, you probably don't want to hold any credit because you are working, you're hustling, you're trying to make income so you can build
Yeah.
up your balance sheet.
Yeah.
On the other hand, your grandfather, your grandmother who are retired have their balance sheet, probably are not capable of working anymore because they're old.
Mm-hmm.
They need income,
Okay.
right? So they
Yeah.
would want to hold credit, right? Hold credit means they will lend out money to the bank and get interest in forms of a yield or a monthly income that they can live
Mm-hmm.
off. And their principal or the money they deposited stays with the bank and they can withdraw it when they need it.
Right.
Right. So in previous 50, 60 years, this credit was mainly powered by IOU. Trust me, I'll pay you back. That was
Yeah.
it.
Yeah.
Right. What Saylor is saying is, why not we build this credit system on top of Bitcoin,
Mm-hmm.
right? So today he's sitting on like $50 billion, give or take, depending on the price and how much he's bought in the last few days, right? Um, and then he's saying, if I have $50 billion worth of assets, essentially Bitcoin, and I'm borrowing money, and I'm not borrowing money to do anything else. I borrow money and go straight buy Bitcoin. And his bet is Bitcoin will grow faster than he has to pay out in interest or dividends every year. Right? To make it simpler, if you could borrow money at 0% and you could put money in treasuries and make 4%, how much money would you borrow? Infinite amount,
As much as I can.
as much as you can, right?
Yeah.
Because it's a clear zero risk trade. Somebody's paying you 0%, we're giving you money at 0%. On the other side, US government is giving you back 4%. You borrow here, you give there, you keep the 4% and call it a day.
Yeah.
That's what a bunch of hedge fund traders and big banks did with carry trade with Japan, and then we can delve it into a different episode if you want to. But if you see that there's an arbitrage where you can borrow for less and earn more,
hmm
you would do it all day long. Like, why do people take mortgages at 4%, 5%, 6%, 7%? Because they believe the real estate is going to grow at 8, 10, 12%.
Yeah. Yeah.
Right? Otherwise, why would they do it? So the same thing, he believes that Bitcoin is going to grow at 29, 30% CAGR. He's paying anywhere between 8 and 11 and a quarter percent on his preferreds. Right? His convertible debt is even lower. He will play this game all along.
Yeah.
Now, only case where this won't work if Bitcoin doesn't grow faster than his dividend payment is growing. Right? If it happens 1-2 years, fine, who cares? Right? You can ride it out. And that's
hmm
where building the cash pile as an emergency fund becomes useful. But in the long run, if you believe Bitcoin is going to grow at a higher rate than 11, 12%, there is like no reason not to do it. Right?
Yeah.
So that makes sense from his standpoint. Like, why does it make sense from the investor standpoint now? Right? Now, let's take an example of one of your grandparents. Right? Let's say your grandfather, he says, okay, I have $1 million, right? That's my entire retirement pool. I need to
hmm
live off of this for next 20 years, right? And I need to make, somewhere between $7,000 to $10,000 a month to live comfortably, so I don't have to, either look for another job or do something else, right?
Yeah.
Or borrow from somebody else or be dependent on anybody else. He can take the $1 million today, give it to the US government, buy treasuries, and he'll get paid 4%. 4% on $1 million is $40,000 a year, right?
Right.
You can't, 40,000 a year is not like 7,000 a month or 8,000 a month. 40,000 a
Yeah.
year is like 3,500,
Yeah.
right? Or even less, to be honest, right? So he can do other things. He could go and buy a corporate bond. So company like Apple, Ford, GM, like they also borrow money to grow their
hmm
businesses. They pay higher than the government.
hmm
So let's say Apple might pay 6%. I'm making this number up. I don't know if Apple pays 6% or lower, but let's assume they do, right? So now on $1 million investment, you can get $60,000.
Yeah.
And I'm ignoring taxes for a minute. We'll talk about
hmm
taxes in a minute as well. Right? And none of this is financial advice. This is just my research, my opinion, my take on this thing. So now, but in this Apple case, he's also taking a big risk on Apple. What if Apple goes bankrupt tomorrow for whatever reason?
Yeah.
They get stuck into a big conspiracy theory, and something uncovers, which drives the company down to the ground. This won't be the first company. This won't be the last company. Like, if people have forgotten Enron, or a lot of other companies that have ran, but Enron is one of the biggest one, like too big to fail, and suddenly like evaporates overnight. So now the other choice he has is he could buy Stretch from MicroStrategy, or Strategy now, which pays 11.25% at today's rate.
Yeah.
So you put in $1 million, you get about 110,000, 112,000
Okay. Yeah.
a year back.
Mm-hmm.
12,000 a year back is about $9,500 a month. Suddenly things look very promising. Oh, wow. Right? That's the first one. And again, sure, you are taking some risk on the management and the company,
Mm-hmm.
but you are not giving money to Saylor that Saylor can build the company that he wants. You're giving money to Saylor so he can buy Bitcoin. If you believe in Bitcoin, and assuming Strategies management team or any other treasury company for that matter is not going to do any fraud, right? There is no risk.
Yeah.
But the key base assumption is you have to believe in Bitcoin. If you don't believe in Bitcoin, don't even look at this. If you believe
Yeah.
Bitcoin is a Ponzi scheme, this is a Ponzi built on Ponzi,
Mm-hmm.
right? Now, coming back for a minute to the taxes part. Any credit interest that you get back is treated as an ordinary income in the United States.
Right.
What that means is you will pay in taxes on that income at your ordinary rate, depending on what other incomes you have, where you fall in the tax bracket. That may anywhere between 10% to 37% on federal rate. And if you live in a state where there is state income taxes, there's that, right? So effectively, the 4% on US Treasury is not usually 4%. It's usually anywhere between 2 and 3%. Depending on what state you live in, what income tax bracket you come in. Like if you live in a state, if you're a high earner and live in a state like California, you might lose 50% of the taxes. If you are low income living in a no state income taxes, a state like Texas, Florida, or Washington, you might end up keeping 3% or 3.25% out of 4 and lose little to, but you will lose some to the government.
Naturally.
Whereas a lot of the dividend payments on the preferreds on Strategy are treated as a return of capital,
Okay.
right? So the the return of capital, what does it essentially means is if the interest is coming back to your return of capital, it basically goes tax free, but it reduces your cost basis. So let's say you bought Stretch at $100.
Mm-hmm.
After 1 year, and for simplicity, let's assume the interest rate is 10%. You get $10 in interest or dividends. So this $10 will be income, but your cost basis will go down from 100 to 90.
Okay.
Right? Next year, you get 10 more back. This cost basis from 90 will go down to 80.
Yeah.
And this will keep going down like that. So up until first 10 years, assuming the 10% interest rate, for first 10 years, you're not paying any taxes. Essentially, you're deferring taxes. You're not never paying it. You're just deferring it.
Yeah.
There's an advantage of deferring, right?
Okay.
So for first 10 years, you're not paying anything. And after that, any dividend that you get, that will be treated as a long-term capital gains, which is treated at a preferential rate versus ordinary income. The
Oh.
long-term capital gains run from 0% to 20%. Plus, there is a 3.8% net investment income tax. So assume like 0 to 24%, give or take, right?
Mhm.
If you have no other income as a single filer, I think it's close to $56,000 or close to 60 maybe, including your standard deduction, everything. If you don't have any other income,
Mhm.
your long-term capital gains could become tax-free,
Wow.
right? So, and that's the reason a lot of people want to, move the taxes from ordinary income to capital gains. When your
Mhm.
money works for you, you pay less taxes. When you work for the money, you pay higher taxes.
Right.
Simple.
Okay.
Right. So I'll stop here. It was a long-winded answer. I'll let you do a follow-up.
No, that's interesting. There was a lot that you said there. What is the difference between like stretch and strife and all of the ones? He
Yeah.
was talking
Yeah.
about this at like Bitcoin meetup, but it went over my head.
So essentially, there are subtle differences. So he started with strike, STRK. STRK essentially it's a, think of it as a preferred equity or a debt instrument
Mhm.
combined with a call option.
Okay.
What does it mean? What it simply said was it launched at $100 par value. And when MicroStrategy, these common equity, MSTR, when it reaches $1,000, you can convert 10 shares of Strike to 1 shares of MicroStrategy or strategy to
Mhm.
MSTR. 10 STRK equal to 1 MSTR. You
Mhm.
would only convert it if it reaches $1,000. Below that doesn't make any sense. And
Yeah.
while you wait, you're getting paid 8% a year.
Oh, wow. Okay.
So that is the debt part.
Yeah.
So that was essentially the idea,
Mhm.
where you can buy it now, or at the launch. I think right now it's like $80 or something. So it's not at par; it's below par, right? And then you just wait. It's a very elegant instrument, but not a lot of people understand it, and it doesn't benefit a lot of people. Here's the reason why. People don't understand because it's a complex instrument. Like, you need to understand debt, you need to understand call options, you need to understand how MSTR price would affect STRK price,
Mhm.
right? And what percentage of your money goes towards the debt payment, what percentage is kind of allocated toward the call option, like how good you feel when you're getting 8%, but your STRK falls 20%. Let's say you bought at $100 and it's now $80,
Yeah.
because MSTR fell from $350 to $130.
Mhm.
So it's a complex thing. The other thing is, it doesn't serve a lot of people's need, because people who are equity investors, they would just go buy MSTR.
Yeah.
People who are option traders, they will just buy straight up options on MSTR. The only difference here was this is a perpetual call option. Usually call options doesn't have an expiration. STRK is perpetual. You can convert it after 10 years. Right? It's not easy to price a perpetual call option, right? Because when you go to perpetuity, how do you build the time value?
You
An option
can't.
price has two things. There's an intrinsic value and extrinsic value. Extrinsic value is time
Yeah.
value. And if the time is unknown or infinite, time value could be practically infinite.
Exactly.
Right? So it's a complex thing. And on the other hand, if you are a debt investor, like somebody like your grandparents, right? They don't want to see the price going down 20%.
Mm-hmm.
For them, capital preservation is a lot more important than capital growth.
Right.
Right? They would rather say, okay, my $100 may not go to 110, but I don't want it to go to 90. Right? So that didn't fly out well. That did not work very well. Still, there is some demand, but it's not the demand that there's an infinite amount of demand for that. Then they
Right.
launched STRF, Strife. Strife is the most senior in the debt capital. And if you have questions about debt capital, I can summarize that in a minute as well. So STRF is the highest or the most senior in the debt debt hierarchy. So if strategy was ever to end up in a bankruptcy, after the convertible debt, STRF holders will be paid first.
Okay.
Right? MSTR holders will be paid last if anything is left.
Oh.
That's the prime difference between debt holders and the equity holders.
Yeah.
Right? So if somebody was to go bankrupt and they have a house, bank comes and auction the house, and if the house goes for less than what you owe bank, you don't get paid anything. You only get paid anything after bank has taken their share and has covered all the fees, and then whatever
Mm-hmm.
is left would come back to you. That's how debt and equity work, right? Business,
Right.
individual doesn't really matter.
Right.
Right. So STRF is most senior, has a fixed interest payment of 10%, if I remember correct. Right. Then they launched Stride. Stride was the most junior, essentially considered more of as a junk bond, but had a higher
Okay.
yield. And so the thing is, if the risk is high, the yield has to be high for people to invest in it.
Okay. Yeah.
Right? As they say, higher the risk, higher the
Higher risk,
reward.
higher the return. Yeah.
Right? So the same way. Lot of them, like all these three, had some demand, but nothing was like, this is it. Then they came up with Stretch, and Stretch is their iPhone moment. Right? Why
Okay.
is that? Right? Stretch is very simple. Very simple in the sense it's a perpetual preferred, which means it's a perpetual debt which will never come due. If you buy it for $100, strategy never has to pay you those $100 back. Right? But they have to pay you interest every month. The interest rate is variable.
Okay.
Right? You might find, oh my God, like variable, what's the point then?
Yeah.
But you deal with variables every day. Doesn't your interest rate on your bank account changes every time Fed changes the interest rate?
That's fair. Yeah.
Right? So it's a variable interest rate. And they have to, keep that, like satisfy the debt holders, that to maintain the value in a very narrow range. They basically said they'll do everything possible to keep the price of STRC between $99 and $101.
Interesting.
How will they do that? We can talk about it, right?
Yeah.
But that's the goal. Now, if they succeed, for a minute, let's assume if they succeed, right? Every day you wake up, the price might be 99.5, 100.2, 99.7, 100.3, 99.8, 100.4, but it's not going to go higher than 101, not going to below 99. It takes away a lot of uncertainty for all those retirees, for debt
Yeah.
investors who
Yeah. It
want
really
income.
does.
Right? They don't want to see their balance fluctuate too much, but they also want a paycheck to drop in their bank account every month,
Mm-hmm.
just like they were doing with treasuries. Like treasuries price fluctuate too. Treasuries prices are not fixed.
Yeah.
Price of treasury fluctuates too,
Mm-hmm.
right? Money market fluctuates, but fluctuates less, right? So And then let's talk about how they're trying to fit this in this 99 and $101 dollar price range. They basically said, anytime it drops below 99, we're going to increase the interest rate to make it more attractive, right? Let's say price goes to 98. They come out and say, okay, interest rate for the next one is going to be 11.5%, a quarter percent or 25 basis point higher than the previous month, which is 11.25 right now.
Yeah.
Right. So higher the interest rate, demand will go higher because, okay, now this is paying even more than before. It becomes more attractive.
Yeah.
Right. And as soon as the price goes above 100, because they are the issuer, they can keep selling at 100. Bam, 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 bam. Right. Not letting it go higher than that.
Mm-hmm.
And if for whatever reason, if it goes above 101, they can reduce the interest rate by a quarter basis points every month.
Okay.
Right? Make it
Okay, that
less
makes sense with the
attractive.
variability then. Yeah. Yeah.
Right. And they're not going to change. They cannot change the interest rate more than a quarter basis point at any given point in time. At least on the reduction side. I think on the increasing they can. I think they have some leeway there. I don't remember exactly, but they have some leeway. So now, if you think about this, okay, if they succeed in this, your balance is gonna stay pretty much flat, and you're gonna getting 10-11% interest,
Mm-hmm.
tax deferred, right? Is it not a bank account that pays you 10-11% and you don't have to pay taxes for next 10 years? And then there is, if you're talking about US tax laws, you can, you can keep using it as long as you're alive, then you can, pass it on to your heirs. Your heirs, when they inherit, the tax, cost basis steps up. They get it again at 100, and they have another 10 years to drive the cost basis down to 0.
Yeah.
So it's like brilliant. Right? So the big unknown here, or big question for people here is, do you believe in Bitcoin? If you do not believe in Bitcoin, this instrument is not for you. The other thing is, this is a new instrument. This is not even a year old, right? So yes, there is demand for it, but the entire demand has not shown up. And there's a reason to that, right? So until the demand shows up, the price fluctuates. Like we have seen in last few months, price has detached from the par, goes to like 93, 94, $95. They increase the interest rate, it slowly starts inching back. And I think today is like 99.8, 99.9, something of that sort. Right? So it's inching towards that 100. The moment it hits 100, strategy can sell as much as the market wants and use all that money to buy Bitcoin.
Right.
Right? That's the game.
Yeah.
Right? So one signal for this, why I said it's an iPhone moment, like probably you won't remember this because you were very young. Apple, when they launched up until iPhone, they were practically at one point and they were dead. The company was almost bankrupt. They brought Steve
Mm-hmm.
Jobs back, right? He brought in iPod. Company started rising up again, and then he launched iPhone, right? First 2 years of iPhone, people didn't comprehend what iPhone was, what it could do, because we didn't even have an app store when it launched.
Right.
Right? It was, here is an iPhone. There are a few apps on it. You can call, you can text. There's a browser, tacky browser, Safari, at least at that time. And then that was pretty much it. You could not go and download any other app and whatnot. So
Mm-hmm.
iPhone 1 and iPhone 2 were practically that. iPhone 3 is where it started revolutionizing. App Store showed up, developers started building for iPhone. Now suddenly everything you did had an iPhone app. And if you compare iPhone from like Apple from that moment to today, it's a monumentally different company. That's exactly where I believe, this is my take, I believe strategy is at. Right? Now, Keith, it's a new instrument. People don't understand it because a lot of people have still not comprehend. They still do not comprehend Bitcoin.
Mm-hmm.
And a lot of institutions are still not allowed due to their regulatory environments, due to their risk processes and whatnot, to just start buying exposure to Bitcoin. Yeah.
Yeah.
And where this becomes a lot more important is, okay, before we go there, we talked about retirees and people who want debt-based instrument or income instruments, right?
Yes.
There are like big institutional buyers of these debt instruments. Think of pension funds, insurance companies,
Right.
college endowment plans, right? Like all of these have some, liabilities, obligations that they have to pay over a period of time.
Mm-hmm.
So they have to have some exposure, if not all. Like they can't put all, like if you're an insurance company, you won't put all of it in treasury bonds when you know inflation is running at 7, 8, 9%, treasury is giving you 4%.
Yeah.
You'll be toast.
Yeah.
Right? If a wildfire or a flood or an earthquake was to hit, you'll be done. You'll be bankrupt. So you will
Mm-hmm.
put some exposure into equities, some into other assets, and then some into treasuries, right? Treasuries mainly to make sure you can service the payments without selling the assets because you're getting some payments back, and it adds some stability to the portfolio. But a lot of these institutional capital that is in this debt-based instruments, they rely on the rating agencies,
Okay.
not Mitch, Fitch, Moody's, and S&P, right? They rate AAA means no risk. U.S. government used to be AAA. I think now it's AA. And then keep going down the ladder. And I think the B minus is some sort of junk bond category. So STRC is rated as B minus right now in junk bond category.
Mm-hmm.
But the key thing is a lot of these institutional funds, they have policies that you cannot buy any instrument unless it is rated blah or higher,
Yeah.
X or higher,
Mm-hmm.
right?
B
Yeah,
minus if you
yeah.
have
So
rating or higher.
like a lot of these institutional funds, they need the ratings to go higher,
Mm-hmm.
right? So I don't know if you have seen the strategies website. I'll show you. They have a good um, dashboard on their website. Give me one. Where is it? Analytics. Here. Right. So if you look at this, can you see it?
Yes.
Right. So like they have created this dashboard that you could look at, right? So if you go to STRC, right, it shows you what the current price is, what is the return, what is the notional, like how much money they have raised on this, what is the current yield, how correlated it is to MSTR, right? How correlated it is to BTC, SPY, and blah blah blah, right? If you go to this debt tab has all the information on how much debt they have, which is not preferred. Like these are convertible bonds expiring in
Yeah.
2028, 29, 30,
Yeah.
31, 32.
Uh-huh.
And then there is this is a very important one, which was a credit tab where they basically talk about their STRF, STRC, STRE, STRK, STRD, right? And they have this idea of BTC rating, right? So what essentially they are saying is how much Bitcoin they have against this debt. So if you look at STRC, it's 4.6x collateralized.
Yeah.
What this means is for every dollar that they borrow in STRC, they have about $4.60 of Bitcoin on the balance sheet.
Wow. Okay.
So if you believe that Bitcoin is a pristine collateral with zero risk, so risk from collateral goes away. Only risk that is remaining here is the company risk,
Right.
right? If strategy was to do something wrong, if they take a wrong decision, if they were to over borrow, over leverage, right? Or they were to borrow and start using the money to do something else, that is a risk. And whatever premium there should be on that, right? So if you use US Treasury 10-year bond as a risk-free rate that the whole market treats, STRC should not be giving 12% yield when Treasury bond is giving 4%.
Yeah.
It should be giving Treasury plus something, so maybe 5%, maybe 6%.
Yeah, but 12% is a lot.
Like 11.5% if you assume the par value, which we are very close to par right now. But that's essentially the idea, right? So if you think about this, it becomes very, very clear that once the institutions start realizing what this thing is, or they open the floodgates and institutions get start building positions in this, I think the bare minimum it is going after the money market, the size of the capital, which is about $7 trillion,
Mm-hmm.
right? And right now the notional capital on STRC is about $3.5 billion. So 3.5 billion to 7 trillion, right? Even let's say I'm not very ambitious on this thing, right? I'm not going to overreach, but let's say 5% of that market comes here. 5%.
Mm-hmm.
7 trillion, 5% is 350 billion. That's 100x from where it is, right? 100x from here it is means they'll be able to buy about 345 or 347 billion dollars worth of Bitcoin. Guess what that does to Bitcoin price, right? Their current Bitcoin portfolio is 50 billion. They'll be
Yeah.
able to buy 7x more at today's prices. Yeah. And we're not even talking about the entire debt market. If you remember that world wealth chart,
Mm-hmm.
right, that is about a quadrillion. The
Yeah.
entire debt market is about $300 trillion.
Right.
Like, let's not overreach there. But where I'm going with this is once people start realizing what this thing is, and if they believe in Bitcoin, there is nothing else you should invest in when it comes to you need income,
Mm-hmm.
right? You need income with minimal risk. You don't want to do anything else, right? You have some capital. This should never be your entire portfolio,
Yeah. Yeah.
right? For any person who's under 40, don't even think about this. Do not,
Okay. Okay.
right? Your focus should be entirely on how do I grow my balance sheet? Simple, period. Nothing else matters, right? Your growth is from your income that you do from your active work, build positions in Bitcoin. Don't even think about anything else until you reach at least one Bitcoin,
Mm-hmm.
like you set your goal for yourself or higher, right? Once you reach there, then you can start saying, are there anything else? Are there any other interesting investment opportunities where I can go? Think about these income funds when you're in your late 40s, early 50s, and say, you know what, I have decent sized portfolio. I would want some income to live on. I've done enough active work. I want to retire. I want to disappear in the
Yeah.
wind.
Yeah.
Maybe. Don't bother until then.
What is the difference between what strategy is doing and then what, let's say, BlackRock is doing with buying Bitcoin and then like launching an ETF?
Uh, BlackRock. So ETF, basic idea of ETF is their job is not to do anything else, buy and hold. And
Hmm.
their holdings are always proportional to the amount of money that flows in.
Right.
People want to buy iBIT, they issue new shares, they buy Bitcoin. People are dumping iBIT, they burn iBIT shares, they sell Bitcoin. That's it, right? And then that's the distinction I said. If you're a treasury company, you have to have an operating business,
Yeah. Okay.
right? That operating business gives you money to buy more Bitcoin, not more investors giving you more money to buy Bitcoin. Because I want an iBIT share, and they have to issue a new share, and they go convert that iBIT share into Bitcoin.
Another question I had was, so you were talking about the difference between equity holders and then debt holders, right? I just want to clarify, like, what is the incentive to be a debt holder and then an equity holder? Like, why might you choose one or the other?
Yeah. Um, the basic difference between equity and debt is debt is less volatile and comes with a standard coupon or a dividend or an interest payment, whatever you want to call it,
Hmm.
right? Equity usually does not have a dividend. Some companies do, but usually doesn't have a payment that's coming every month, every quarter, every year. Even if it is, it's usually minimal, right? Volatility is usually higher, right? Um, if you are focused on growth, your goal is I want to grow my portfolio. I put in $100 today. I want this $100 to grow as high as possible. I can wait.
Hmm.
You would be an equity investor,
Right.
right? If you want income to live off, you are a retiree. You're living off of Social Security, but you need supplemental income, and you have a small portfolio. You can take a part of that and then generate income from there, add it on top of Social Security, so your every month income goes higher. You can live off of it.
Hmm.
And because you are already in the late stages of your life, you probably don't need your portfolio to grow as big as you would when you are 20 years old,
Right. Okay.
right? So
Yeah.
depending on what is the need of the portfolio, and that's the reason personal finance is very, very personal. There is no one size fit all. There is no standard course that somebody can attend and say, I understand personal finance. There's a reason it's called personal finance and not finance, right? Your needs are very different than mine. My needs are very different than my father's,
Hmm.
right? Because we are at different stages of life. Oh.
Okay. I think switching gears a little bit here, coming back to like what we were talking about in previous episodes with, BlackRock and the ETFs. I see a lot of like posts on X when they're referring to institutions buying out Bitcoin, calling it paper Bitcoin. What does that mean? Is that just like lying and saying you have Bitcoin when you don't?
Um, in simplest word, yes.
Okay.
But to understand this, remember a couple of episodes ago we talked about for every bar of gold or silver, they had like 1:30 to 1:100, depending on what data you select,
Yes,
claims,
yes,
right?
yes.
So essentially, somebody has written more IOUs than the actual physical stuff.
Hmm.
And to understand this, like what we should understand what a bank run means. I think that will clear a lot of things in your head. You've probably heard bank run uh, phrase, right?
Yeah, yeah.
What does bank run mean? So we just remember we were talking about how banks operate. They collect money from the depositors, loan it out,
Hmm.
right? And their only hope is not too many depositors will come at the same time and ask for their money, because the money isn't there.
Right. Okay.
That's what fractional reserve banking is.
How is this not illegal?
It's not that that's how it operates. Because if they were to, so in an ideal world, banks should have 100% collateral. So for example, if I borrow money from you, you give me $100, I go use it to do whatever. And tomorrow, if you want $100 back, I don't have that money.
Yeah.
Right? So let's make it even simpler, right? You give me $100 and I agree I'm going to pay you 2%, right? 2% a year. As long as you hold the money with me, 2% a year, I'll pay you monthly, so whatever cents it becomes every month, I'll pay you that, right? Like 15, 16 cents, whatever that is. And then I take that $100 and go to my friend, Jack, and I basically say, hey, Jack, you said you needed money. I can give you $100, but I need 4% back. He's like, okay, done. So I gave him $100. So I don't have $100.
Yeah. Yeah.
But on the same $100 bill, there are two IOUs now. You have an IOU on me. I have an IOU. Or my friend has an IOU towards me. I have towards you. Right? Now, if you come back to me tomorrow and say, I need my $100 back, I'm toast. Because Jack has said he's going to give me back like 2 months, 3 months, 4 months later, whenever. If he comes back and say, I'm done, I don't need it anymore here, and here's the interest and call it a day, great. It's okay. But if he doesn't and you come back, I'm toast.
Yeah.
Right? In an ideal world, when you give me money, I should be holding that as a reserve. So whenever you come, I have the money ready for you. But in that world, I cannot give you interest.
Yeah.
Rather, I'll have to charge you a fee to hold this money for you. Yeah?
Yeah.
So to make this whole thing work, they came up with this brilliant idea of fractional reserve banking. And fractional reserve banking basically says, whatever deposit comes, I only have to keep a fraction of that in reserves. And I think right now the fractional reserve requirements are close to 0%, if not exactly 0%. So you give me 100, I can lend out all 100 out. Like if the fractional reserve was 10% out, if you give me 100, I can only lend out 90, I have to keep 10. So as long as you're asking me less than 10, I can give you without blowing up. Right? So in bank run, what usually happens is a lot of depositors show up and say, give me my money. And they don't have funds. And then the news gets out and the banks start failing. Because the more people complain about I'm not able to get my cash out, more people will line up. Give me my money
come
too.
to get their cash out, yeah.
Right? And that's what bank run is. And whoever goes there first can take their money out and disappear, but the others will be standing in the line. And that's where this whole idea of FDIC and Fed being the last, lender of last resort and whatnot. That's exactly what happened in Silicon Valley Bank 2 years ago or 3 years ago, whenever it was. Right? So now translate that into this fictional world of paper gold, paper silver, maybe paper Bitcoin, I don't know. Right? As long as people don't come and say, hey, I bought this gold ETF or silver ETF, I want to redeem it for my gold bar or silver bar. It's fine. Because as long as people are willing to settle for cash, it's okay. But if it's 1:30x or 1:100x, IOUs, if 5%, 10% people will show up to, get their money, to get their physical, possession, these things will go belly up.
Right.
So that's essential, and this has been prevalent for a long time. Why do banks do it? Because banks make money. Banks make money off of derivatives. Derivatives, these ETFs, and majority of the ETFs do not allow redemption in kind. Even iBIT, they
Yeah.
allow it, but I think
Yeah.
you have to have a large balance, and it's only allowed for institutional investors. So you and I, if you own 100 shares of iBIT and you say, hey, give me my 100 shares worth of Bitcoin, you can't. You have to sell it and go buy Bitcoin. You can only get cash out. Now, do I believe there is paper Bitcoin? Maybe. I'm doubtful, right? But what I'm not doubtful for is there is a large amount of suppression that's happening because of derivative markets. I don't know if you saw it or not. Yesterday, something came out about Jane Street, one of the big market makers, algorithmic market makers. Every day for last several weeks at 10 a.m. Eastern,
Mm-hmm.
they would put aggressive sell orders to suppress the price of Bitcoin.
Wow.
And another firm which went bankrupt around the time or after FTX went belly up, they basically said Jane Street was involved in pushing the Terra Luna, the stablecoin, down, which basically brought them down and FTX down and whatnot. So they filed a lawsuit. And what people have been reporting on X, again, what I'm sharing is all of what I've read on X, so I'm not sure if it's authentic or not. What we are seeing for last 2 days is that 10 a.m. Eastern time suppression or large sell orders haven't shown up for 2 days. That's the reason the price has started recovering a little bit. I don't know how much truth there is to it, but
Yeah.
I know for a fact derivatives have been used for suppressing the price,
Mm-hmm.
and they will continue to be used because market makers make money off of both sides of the trades. If you are an option seller or a future seller, they buy from you, charge you a fee. Option buyer, they sell it to them, charge them a fee.
And they are
For
making
them,
money.
it's better to keep the price in a tight range and leaning depending on which side is they're going to make more money on. They'll stick because their money and their income is not going to go up if the price goes up or price goes down. They're going to make the commissions. They want people
Yeah.
to trade more.
Yeah.
So just a simple answer to your question: do I believe there is paper Bitcoin? I don't think so, because it's very easy for any good analyst to do back of the envelope calculation and say, you know what, the amount of Bitcoin trading that is actually happening in the financial market and what is actually happening on the chain. Because
Mm-hmm.
if real Bitcoin is moving as the financial markets are moving,
Yeah.
it's leaving the traces behind.
Yeah. It would show up.
You can't do that for gold. You can't do that for silver. You can't do that for anything else. But for Bitcoin, you can.
Mm-hmm.
So anybody can look there and say, okay, you know what? Yeah, this the movement here is multi-fold higher than what is happening here.
Mm-hmm.
Now, would you say, if you sell your iBIT shares to me, you sell it, I buy it, does it move Bitcoin? Probably no.
No, it
Like
doesn't.
it won't move on Blim blockchain. But so it's the
Yeah.
large numbers that matter. Like if iBIT has to or BlackRock has to go issue new shares, so they have to buy Bitcoin, or they have to burn shares, so they have to sell Bitcoin. Like those transactions will be visible. Since you asked about treasury companies, I want to remind your audience, young investors, treasury companies are not for everyone. Be careful out there, and I will show you one example. Nothing against this company or any other company, but I'll share one example of Nakamoto. Look what happened to their share, right? This is around the time last year, March, April timeframe is when they announced they're gonna become a Bitcoin Treasury company. They went from a $1.90 to all the way to, whatever, like $25, $26,
Yeah.
right? And now they're like 26 cents. So they're down like 99%, right? So every treasury company is not strategy, and even strategy is not for every investor. Do not delve into treasury companies until you have built a decent base layer of Bitcoin, because you can always buy more strategy. You won't be able to buy more Bitcoin. Once Bitcoin disappears from the exchanges, you won't be able to buy at these prices. Like strategy could split its share. Strategy can issue more shares, right? There could be another strategy in the future. So MSTR might be out of reach, but there might be somebody else who shows up who's running something interesting on top of Bitcoin.
Mm-hmm.
But there would not be a second Bitcoin. So that's my sole advice to every young investor. Do not delve into any treasury company until you build a decent Bitcoin allocation. And if you choose to go this route, do your research, because every treasury company is not constructed the same way.
Yeah. Yeah, I was gonna say it's sounding like, while obviously treasury companies are interesting to talk about, to read about, um, it's looking like at least my sole focus right now should be Bitcoin, Bitcoin, Bitcoin.
Yes. Yes. Like I hold some positions in strategy companies, but I only hold two. I don't hold any. I only believe in strategy and Metaplanet. They are tiny part of my portfolios. Even both of these companies are down like 60 to 80% from their top, right? So like if somebody was to buy all those hypes, those 50 cent a share company that went to $35,
Yeah.
those shares are not coming back to $35 ever,
Mm-hmm.
right? Would Metaplanet come to those prices again? I don't know. My price was not the highest, but it's such a tiny fraction of my portfolio that it doesn't really matter. I believe strategy will come, but strategy is not the primary position for me. My primary position still stays Bitcoin, right? So that's it. If there is any advice in this, is do not buy the hype. Do not jump into any strategy, any treasury company just because people are talking about it next. Sure, the last hype cycle is over, but there will be another.
Yeah.
Trust me.
Yeah.
If it comes this year or next year, there will be another. Do not put your life savings into any company that's rising very fast, because you don't know. You really don't know.
I think that is everything that I had for today. I wanted to finally get this episode out because I think we've been talking about doing one that's on BTC TCs for quite some time, and then just kept doing other topics instead. So it's good that we finally got this one out there. It's good that I cleared up some of my misconceptions and some of my questions that I had about this stuff as well. Um, I think that is all I had to say for the listeners. I hope you enjoyed today's episode. It was definitely a very information packed one, and this one, I don't think it was easy to comprehend either, so it might be a bit of like a hit or miss depending on what kind of person you are and how good your knowledge is with markets and investments. Um, So I'm curious to know if you guys like this type of content or if you prefer more of the macro explainers or the AI stuff or something entirely new. With that being said, I don't actually have a topic in mind for next Sunday yet. So if you do have something, drop it in the comments and I will have a look through and pick one of them. If you've got any questions, please, please, please help me out, help my dad out. Coming up with content ideas is very hard. Yeah, Dad, do you have anything that you want to say?
I would just say that if there was any part of the this episode that wasn't clear, either leave it in the comments or reach out to me on X, DM me. I'll do my best to explain it as clearly as possible.
Yeah, sweet. That's at Global HODL on X. His links are also in the description of this video. So that brings us to the end of today. And as always, stay curious, stay skeptical, and stay orange pilled. I'm your host, Nikki. This is my dad, and we will both see you next Sunday.